Let's talk about exit considerations for a private equity fund. The first question they might ask is, when does the exit need to take place? Is the management team amenable to an exit and ready for an exit? What paths or avenues are available to exit, whether it's an IPO or a sale to a strategic? What about the capital structure of the business? Does it make sense to sell it at this point? And how's the business strategy doing? From a business perspective, does it make sense? Who might buy this business, whether it's public investors, a strategic buyer, or another private equity fund? And finally, what would our internal rate of return be if we were to sell it at this point? Let's take a closer look at the different types of exits that a private equity fund could take. The two main categories would be a total exit or a partial exit. So in terms of a wholesale exit from the business, there could be a trade sale to another buyer, a leverage buyout by another private equity firm, or a share repurchase. In terms of a partial exit, there could be a private placement where another investor buys a piece of the business. There could be a corporate restructuring where other investors get involved and increase their position and the private equity firm reduces theirs, or corporate venturing and management increasing their percentage ownership in the business. Finally, there's a flotation or an IPO, which is a hybrid of the two. This involves the company being listed on a public stock exchange and trading. Typically, only a percentage of the company is sold in an IPO, say 25 to 50% of the business. And then the private equity firm may exit the rest of their position later as time goes on and they can slowly unwind the rest of the company.